Imagine you're building a team. You don't just pick the fastest runner or the smartest strategist. You pick a balanced group that works together, covering each other's weaknesses. That's exactly what modern portfolio theory, or MPT, tries to do with your investments. Developed in 1952 by economist Harry Markowitz, MPT changed the way we think about risk and return. Instead of just chasing high returns, the idea is to build a portfolio that gives you the maximum possible return for a given level of risk. Think of it this way. It's not about picking the best stock, it's about how different assets work together in a portfolio. Markowitz argued that it's the portfolio as a whole, not the individual pieces, that truly matters. MPT introduced a groundbreaking idea. Diversification can actually reduce risk without necessarily lowering your return. So, how does that magic work? Let's break it down. At the heart of investing is one simple truth. Risk and return are always connected. The higher the potential return, the higher the risk, and vice versa. But let's define those terms more clearly. Expected return is what you hope to earn, based on probabilities. Risk, in MPT, is often measured using something called standard deviation. In simple terms, that's how much your returns bounce around from year to year. Picture two investments. One gives you 7% return every year, like clockwork. The other averages 7%, but swings wildly between 2% and 12%. Which one would you pick?
MPT says, don't just look at the average return, also consider how reliable that return is. Volatility matters, because your real-world results depend not just on the average, but on the path your portfolio takes. This leads us to one of MPT's most powerful ideas. You can combine risky assets in a way that actually reduces overall risk, thanks to how their returns interact. Here's where it gets really interesting. Imagine two assets. Asset A goes up when the economy is booming. Asset B goes up when the economy slows down. Now, if you own both of them, their ups and downs cancel each other out a bit. That's the power of correlation. Correlation measures how two assets move in relation to each other. If they move together, they have positive correlation. If they move in opposite directions, that's negative correlation. If their movements are unrelated, that's zero correlation. MPT says this: don't just pick good assets. Pick assets that don't move together. That's why a portfolio of just tech stocks, even if they're all good, can still be extremely risky. If one crashes, they probably all will. But a portfolio with stocks, bonds, commodities, and maybe real estate, now we're talking. When assets are uncorrelated, you smooth out the volatility. You don't eliminate risk, but you spread it around in a smarter way. Nobel laureate Paul Samuelson once said, "Diversification is the only free lunch in finance." Here's why. Let's say you invest in 5 different assets that each have a 10% risk individually. If they're perfectly correlated, meaning they move together, your portfolio will also have 10% risk. Thoughtful. But if they're uncorrelated, or even better, negatively correlated, your overall portfolio risk drops even though you haven't changed the assets themselves. Relax, it's like a seesaw. One side goes down, the other comes up, and the balance keeps the system stable. Diversification doesn't just mean owning many assets. It means owning assets that behave differently in different conditions. This is why index funds that hold hundreds of different companies are often recommended for long-term investors. And it's also why adding things like bonds, REITs, or commodities to a stock-heavy portfolio can actually boost performance while reducing risk. Thoughtful, smart diversification leads us to the most powerful visual tool in modern portfolio theory. Let's talk about a graph. On one axis, you have risk, standard deviation. On the other, you have expected return. Now, plot every possible combination of asset allocations on this graph. Stocks, bonds, commodities, you name it. You'll get a big cloud of points. Some low return, low risk, others high return, high risk. But there's a curve that forms along the top of that cloud, and that's the efficient frontier. Explanatory. Every point on the efficient frontier represents a portfolio that gives you the highest possible return for a given level of risk. Warning, if your portfolio is below that line, you're taking more risk than necessary for the return you're getting. Confident. If you're on the line, you're optimized. Guiding, let's say you want moderate risk. You'd move along the frontier until you find the point that matches your comfort level, and that's your ideal portfolio. It's like booking a flight. Why would you take the longer, more expensive route when there's a faster, cheaper option? MPT helps you find the most efficient portfolio for your risk tolerance. The amazing part? The frontier shifts depending on the assets you include and their correlations, which means you control your portfolio's efficiency through intelligent diversification. So far, we've talked about portfolios made up of risky assets, stocks, bonds, commodities, and more. But what happens when we throw a risk-free asset into the mix? For example, let's say you add something like U.S. Treasury bills to your portfolio, an investment with nearly zero default risk. Modern portfolio theory evolves further here, creating something called the capital market line, or CML. Here's how it works. When you combine a risk-free asset with a risky portfolio, say one that lies on the efficient frontier, the resulting line of combinations becomes straight rather than curved. This straight line is the capital market line. Why does this matter? Because the CML shows the most efficient combinations of the risk-free asset and the market portfolio, the point on the efficient frontier where the Sharpe ratio is highest. So instead of just being efficient, now you're super efficient, achieving the best trade-off between risk and return. Investors can choose a point along this line depending on how much risk they want. For example, a conservative investor might hold mostly treasury bills and a little of the market portfolio. A more aggressive investor might borrow at the risk-free rate and invest more into the risky portfolio. This brings us to another critical concept, the Sharpe ratio.
The Sharpe Ratio is a simple but powerful tool that tells you how much excess return you're earning for each unit of risk. Here's the formula. Divided portfolio return minus risk-free rate divided the portfolio standard deviation. The higher the Sharpe Ratio, the better your risk-adjusted return. In other words, you're squeezing more return out of each ounce of risk you're taking. Why is this important? Because investors don't just want high returns, they want high returns per unit of risk. If two portfolios offer the same return, but one is more volatile, the one with the higher Sharpe ratio is the smarter choice. So when constructing your portfolio, your goal is to find the point on the capital market line that matches your risk tolerance and maximizes your Sharpe ratio. That's your optimal portfolio, the sweet spot where risk and return are working in harmony. But here's where we need to pause and face reality. While modern portfolio theory is incredibly useful, it's not perfect. Like any model, it has its limitations. First, it assumes you can predict the future. That is, you know the expected returns, volatilities, and correlations of all assets. But in real life, markets shift, correlations change, and black swan events happen. What looks like a low-risk portfolio today might become highly volatile tomorrow. Second, MPT assumes investors are rational and always make decisions based on risk and return. But we know that emotions like fear and greed often drive investor behavior. Then there's normal distribution. MPT assumes that asset returns follow a neat bell-shaped curve, but real markets have fat tails. Extreme events occur more often than predicted.
2008, the pandemic crash, flash crashes, all prove that outliers happen more frequently than MPT would suggest. Finally, MPT doesn't account for liquidity, taxes, or real-world constraints like minimum investment amounts or transaction costs. So while it's a fantastic framework, it's not the full picture. That's why newer theories have emerged. As investors began to question some of MPT's assumptions, new models were developed to improve or complement it. One of them is postmodern portfolio theory, or PMPT. PMPT modifies the definition of risk. Instead of using standard deviation, which penalizes both upside and downside volatility, PMPT focuses on downside risk only. Because let's be honest, no one complains about earning more than expected. PMPT uses metrics like Sharpe Ratio, which adjusts returns only for bad volatility, the kind that actually hurts you. Then there's behavioral portfolio theory. This approach acknowledges that investors aren't always rational. People often build mental buckets for their money, like safe money and aspirational money, rather than managing it as one big pool. They chase trends, panic sell, and ignore math. Behavioral finance incorporates human psychology into portfolio theory, recognizing that real-world investors make decisions differently than theory suggests. While these models aren't as mathematically elegant as MPT, they offer a more realistic view of how people actually invest. Still, modern portfolio theory remains the foundation upon which most asset allocation strategies are built, including robo-advisors and pension funds. So what should you take away from all of this? You don't need to be a financial analyst to apply modern portfolio theory. Here's how to use it in your own life. Think in portfolios, not in stocks. Stop trying to find the next hot stock. Focus on building a mix of assets that work well together. Diversify across asset classes. Use stocks, bonds, real estate, and maybe even gold or commodities. Mix U.S. and international markets. The goal is to spread risk, not concentrate it. Understand your risk tolerance. Are you okay seeing your portfolio drop 15% in a bad year, or would that keep you up at night? Your answer should guide how much risk you take. Rebalance periodically. Over time, some assets will grow faster than others, throwing off your balance. Rebalancing brings your portfolio back to your intended risk level. Use low-cost index funds or ETFs. These funds give you broad exposure to markets at a fraction of the cost of active management. They're perfect tools for building an MPT-inspired portfolio. Ignore noise. News headlines, social media trends, hot stock tips, none of that should derail your long-term portfolio plan. Remember, you're not trying to beat the market every week. You're trying to maximize returns for the risk you're willing to take over the long run. Modern portfolio theory gives you a roadmap to do just that. And while it may sound complex at first, its principles are surprisingly simple and powerful when applied with discipline.